Hi, welcome back. So today I'd like to talk about bad debt expense. Bad debt expense is the risk that a business is exposed to when it sells goods and services to customers and clients on credit. Now, I'm not talking about credit card transactions here. What I'm talking about is someone comes into my store, buys $1,000 worth of merchandise from me, walks out the door, and all they've done is they've signed a paper promising to pay me that $1,000 at a later date. I haven't received a single dollar in cash, or any other asset for that matter, from that individual. Okay. What I've done is I've extended store credit to that person. Now, maybe I've known that person, I've done business with them for years, or maybe I've had them fill out a form with their social security number, name, address, stuff like that allows me to do a credit check on them, whatever. I've extended store credit to that person. Now, why would I do that? Why would I let someone walk out the door with my merchandise in exchange for a promise to pay me a sum certain at a later date? To boost up revenues. If you remember, if this is an accrual basis accounting business, an accrual basis business, and if you remember the definition of revenue recognition for accrual basis, revenues are recognized when the earnings process is substantively complete, and there are 4 criteria that must be met for the earnings process to be substantively complete. 1, there must be persuasive evidence of an agreement between the principals. Well, that's the document, the promise to pay that the person signed. 2, the goods must have been transferred or the services rendered. Well, the customer walked out the door with $1,000 worth of merchandise. 3, the seller's costs must be fixed or reasonably determinable, and there must be reasonable likelihood of receiving payment. Well, I wouldn't have extended store credit to the person if I didn't think they were going to pay me. So if all 4 conditions are met, I can recognize that transaction as a revenue without ever having received a single penny in cash or any other kind of asset. And so of course, the higher the revenues, the higher the net income, the happier the business owner. So we extend store credit as a way of boosting up revenues. Now, like I said, the risk to extending store credit is that some people may not pay you. So let's kind of talk about a hypothetical here. It's January 1st, 2020. Someone walks in the door, and I extend store credit to them, and they walk out the door with $1,000 worth of my merchandise. And let's say that merchandise actually cost me $750. So what I'm going to do is I'm going to debit accounts receivable Mr. X for $1,000, and I'm going to credit revenues for $1,000. So I'm recognizing the revenue. Then I'm going to debit cost of goods sold for $750, and I'm going to credit merchandise inventory for $750. Okay. So that's recognizing my cost. Now, let's say December 31st, 2020 rolls around. And this guy, I've been, hey, you were supposed to pay me within 60 days, what's going on? And he keeps, blowing me off. He keeps, I'll pay you next month, having some liquidity issues, blah, blah, blah. So December 31st rolls around, and I'm not sure if this guy's going to pay me or not, okay? So there are some things that I can do here, okay? Again, I've sold on credit, haven't received anything from him, not sure if he's going to pay me or not. There are a couple of ways that I can handle this. I can do a direct write-off where I just say, I'm not going to ever get the $1,000 out of this guy. So what I would do is I would debit an account called bad debt expense for $1,000, and I would credit accounts receivable Mr. X for $1,000, and done, gone, forget about it. But the fact is, most businesses would rather carry a risky or a questionable account, account receivable, rather than write it off. And one of the reasons why is by carrying on the books that questionable account receivable, you're actually artificially inflating the assets and, by implication, the balance sheet. Okay, I've seen where businesses have carried accounts receivable on the books for years, and they've been trying to collect. And I remember in one case, I was, why are you still carrying this guy? Well, he'll pay us, but it's been 4 years. Well, yeah, but he'll pay us. And I went and did some research, and I came back and said, he's never paying you. He died 3 years ago. Okay, you got to get this off the books. And what I'm getting at is a lot of businesses, when faced with the option of recognizing a bad debt and writing it off, or carrying it as an account receivable, they'll opt to carry it as an account receivable. Okay. So like I said, let's say that December 31st rolls around, and I don't know, am I going to get money from this guy or not? I don't know. So I decide I'm not going to do anything. I'm just going to keep calling him until, something happens. And let's say June rolls around, June 2021 rolls around, and I find out that guy is gone. He sold his store, he sold his home, he's cleared everything out, lock, stock, and barrel, he's headed for the hills. I am never going to get that $1,000. Okay, I guess I'll just do a direct write-off, because now I know I'm not going to get that $1,000. So I'm going to debit bad debt expense for $1,000, and I'm going to credit accounts receivable Mr. X for $1,000, right? Wrong. Going back to your generally accepted accounting principles, there's this little concept called the matching principle. It's a little inconvenient for us here, because the matching principle says that we have got to match our expenses to the time period in which those expenses generated revenues. Well, it's June of 2021, and I'm trying to debit an expense for a bad debt expense for $1,000, and that relates to a revenue that was recognized in January of 2020. So I got revenues in 2020, the expense in 2021, different time periods, can't do it. Violates the matching principle. What am I going to do? There's nothing I can do. I am saddled with that account receivable. And this kind of goes back, and this is where things get a little complicated or hard to explain, is this is why back on December 31st, I got to do something. I either got to do a direct write-off, or there's these things called the allowance methods. There are 3 allowance methods that I can use. The allowance method for credit sales, or for accounts receivable, or for the aging of accounts receivables. Forget completely about the aging of accounts receivables. We're just going to focus on the allowance methods for the credit sales, also known as the income statement approach, and the allowance method for the accounts receivable, which is also known as the balance sheet approach. Okay. So it's December 31st, and like I said, I've got this $1,000. I might get paid, I might not, I don't know. I don't want to do a direct write-off, because I still might get paid. But at the same time, I can't just not do anything. I have to do something. So using the percentage of credit sales methodology, what I do is I look at my credit sales for that year. Now, again, credit sales, store credit I've given to customers, not credit cards, okay? So I look at my credit sales for that year, okay? This is it's a temporary account, it's a revenue account, it shows up on the income statement, it's going to get zeroed out at the end of every year. And let's say that okay, so I'm looking at the credit sales for that year. Let's say it's $1 million. And I look at my historical trends from previous years, and I go about 10% of each year's credit sales go bad. So on December 31st, I'm going to debit an account called bad debt expense for 10% of that year's credit sales, which let's say was $1 million. So I'm going to debit bad debt expense for $100,000, and I'm going to credit this new account called allowance for doubtful accounts for $100,000. Now the allowance for doubtful accounts is a permanent account, okay? It's a balance sheet account, and it's an offset to your accounts receivable. So when you look at the balance sheet, you'll see like maybe $5 million in accounts receivable, less the allowance for doubtful accounts, which will give you a net of estimated collectible accounts receivable. Okay. So it gives you, when you look at the balance sheet, it gives you a little bit better idea of what you can really expect to collect from the people whom you've extended credit to. Okay, so you get a little bit more accuracy there. Now the problem with this approach is that the allowance for doubtful account expands over time. It's a permanent account. It shows up on the balance sheet. It's a contra asset account, as I previously mentioned. And it's going to keep expanding over time. And so the end result is a methodology that you've implemented to bring accuracy is actually going to start introducing inaccuracy into the balance sheet, because again, the allowance for doubtful account is an estimate of who's going to go bad, okay, or the accounts that are going to go bad. So it's a question mark. Well, anyway, getting back to the actual procedure. So, like I said, we would debit bad debt expense for $100,000 or 10% of your annual credit sales, which in this scenario was $1 million. So we would debit bad debt expense for $100,000. We would credit allowance for doubtful accounts for $100,000. And then in June of 2021, when I finally realized this guy skipped town, that bum, then I'm going to debit allowance for doubtful accounts for $1,000, and I'm going to credit accounts receivable Mr. X, that bum account. So now I've brought my allowance for doubtful accounts down to $99,000. So think about the allowance for doubtful accounts as they're the total amount of credit, store credit that I've extended that might go bad. I don't know if they will, I don't know if they won't. Now with Mr. X, I do know on June 30th, I did decide that Mr. X is bad, and I debited allowance for doubtful accounts for $1,000, and I credited accounts receivable with Mr. X for $1,000. Mr. X is known to be a bad expense now. And so I deducted that $1,000 from the allowance for doubtful accounts. So it's gone down from $100,000 to $99,000. So what I'm getting at is the allowance for doubtful accounts, just think of it as a big question mark. Now, like I said, the bad thing about that methodology is now I got a balance of $99,000 in the allowance for doubtful accounts. The next year comes around, I do the same thing. Let's say it's the exact same numbers. $1 million in credit sales, 10% default rate. So once again, I'm going to debit bad debt expense for $100,000, and I'm going to credit allowance for doubtful accounts for $100,000. That brings it up to $199,000. So that shows up on the balance sheet. Again, my accounts receivable less now $199,000. So what I'm getting at is the allowance for doubtful accounts keeps growing, okay? And as it keeps growing, it keeps eroding the amount of estimated collectible accounts. And that's misleading now. So a system that was intended to correct misleading information is introducing misleading information, is what I'm trying to say. So that leads us to the other allowance method, which is the percentage of accounts receivable. Now, accounts receivable is a permanent account. I think it's the better way to go, because the accounts receivable account has all of your accounts, all the people that you've extended credit to, okay? You're not focusing just on this year's credit sales, you're focusing on all the people that you've extended credit to. And you're coming up with an estimate based on historical data and analysis. You're coming up with an estimate of the default rate for them. Let's again say it's 10%. So using the allowance method for accounts receivable, what we would do is we would look at the accounts receivable, the balance of the accounts receivable account. Let's say again, it's $1 million. I've estimated the default rate is 10%. So I would debit an account called bad debt expense for $100,000, and I would credit allowance for doubtful accounts for $100,000. Just like with the allowance method for credit sales. Then in June, I would, when I find out Mr. X is a deadbeat, again, just like with the percentage of credit sales methodology. I'm going to debit allowance for doubtful accounts for $1,000. I'm going to credit accounts receivable Mr. X for $1,000. Okay, so that's all the same. But where the percentage method for the allowance, the allowance method for the percentage of accounts receivable differs from credit sales, is that in the next year, when I go through that estimation process again, and again, let's say it's $1 million in accounts receivable, 10% default rate, instead of just crediting the allowance for doubtful accounts for $100,000 and debiting bad debt expense for $100,000, I'm going to look at the balance in the allowance for doubtful accounts account. And like I said, in this case, it was $99,000. I calculate, based on the percentage of accounts receivable, the allowance for doubtful accounts needs to be $100,000. That's a $1,000 difference. So I'm going to debit bad debt expense for $1,000, and I'm going to credit allowance for doubtful accounts for $1,000 and bring it up to the balance of $100,000. And then, just like with the other allowance method, once I get to a point where I decide somebody has gone bad, I debit allowance for doubtful accounts for that amount, and I credit the account receivable, Mr. L, Mr. Z, whatever, for the appropriate amount. So what I'm getting at is, when it comes to extending credit, you have to both be looking forward. Okay, so at the end of the financial periods, if you've got accounts that are questionable, you've got to make a decision. Are you going to do a direct write-off right then and there, or are you going to carry them into the next period, and then as time goes on, write the accounts off using either the percentage of credit sales or the percentage of accounts receivable methodology? And if you opt for the latter of the two, if you're going to do the percentage of credit sales methodology, that's fine. It's uncomplicated. You just do your calculation, and every year you credit the allowance for doubtful accounts for whatever your resultant is. However, if you use the percentage of accounts receivable, you've got to always keep an eye on the actual balance in the allowance for doubtful accounts, and then do your calculation. And if there's a difference, that's the amount that you're going to credit to the allowance for doubtful accounts. It sounds much more complicated than it really is, but it's actually extraordinarily simple to do. It's just very difficult to get the concept across. And hopefully that helps.